Welcome back to our Financial Independence Friday series, where today we'll be discussing the two main types of life insurance. If you find this video helpful, please hit that like button. If you have any questions or would like to share your thoughts, please leave a comment below. Did you know that life insurance is like a parachute? You hope to never use it, but it's comforting to know it's there. It's important to understand the differences between the two main types, term and whole life insurance. Both provide death benefits, but they differ in a few ways. Term life insurance covers a specific period, usually 10, 20, or 30 years, has no cash value, and is low cost. Whole life covers the entire life of the insured, has a cash value component, and is more expensive. It's important to understand the drawbacks of whole life insurance, which we'll refer to as the 4 awful rules of whole life insurance. These include, number 1, no cash value for the first 3 to 5 years. Whole life insurance typically does not accumulate cash value for the first few years. This means if the policyholder cancels the policy within the first few years, they will not receive any money back. Number 2, minimal returns of 1% to 2% interest. The savings component of whole life insurance is tied to a fixed interest rate, which is lower than the returns offered by other investment options. Number 3, you must borrow your cash value from the insurance company and pay it back to the company at 6% to 8% interest. If the policyholder wants the cash value of their whole life policy, they must borrow it from the insurance company and pay interest on the loan. This can be costly because it's your money which you must borrow from them. And number 4, you only get one or the other. If the policyholder passes away, their beneficiaries receive the insurance, but the cash value of the policy remains with the insurance company. If the policyholder wants to withdraw all the cash value, they must cancel the policy, forfeiting the insurance. So, if you're considering whole life insurance, just remember the 4 awful rules. It sounds like the title of a horror movie, doesn't it? In contrast, term life insurance is better simply because of the low-cost option for more coverage, allowing the policyholder to invest more money in higher-yielding investments like mutual funds. Here are 4 benefits of term insurance and investing in mutual funds. Number 1, your cash accumulates immediately in mutual funds. Mutual fund proceeds accumulate immediately, allowing you to start building wealth right away. Number 2, you can get 9% to 12% returns over time. Mutual funds offer the potential for higher returns than the fixed interest rates offered by whole life insurance. Number 3, you don't have to borrow your money, it's yours and you can just take it. Unlike whole life insurance, there is no need to borrow money from an insurance company to access your savings. Your money is readily available for withdrawal or investment as you see fit. And number 4, if someone passes away, the money goes to the beneficiary of their choice. The death benefit of term life insurance goes to the beneficiaries, while the proceeds in mutual funds are also passed on to the beneficiaries, resulting in a larger payout overall. When referencing term life insurance coupled with mutual funds, it's like a peanut butter and jelly sandwich. They're great on their own, but even better when you combine them. Now let's be clear. It's better to have some life insurance than no life insurance at all. However, those who benefit most from whole life insurance are not the client, but the company and the agent, because they get paid 5 to 10 times more to sell whole life policies. Avoid insurance agents who don't have investment licenses and push whole life insurance on you as an investment or a great way to save money. Almost all financial professionals who are fully licensed will agree buying a term life insurance policy and investing into mutual funds is always a better plan. More insurance coverage at a lower cost and being able to get higher returns on your investment is an obvious choice. In conclusion, the drawbacks of whole life insurance, including the 4 awful rules, make them less attractive than a term life insurance policy, coupled with investing into mutual funds. By taking advantage of the immediate accumulation of wealth and higher returns offered by mutual funds, along with the lower cost and larger payouts provided by term life insurance, individuals can create a more effective and efficient financial plan for themselves and their loved ones. That concludes our video. If you enjoyed this information, please comment, like, and share. Also, make sure to subscribe and hit the notification bell so you don't miss our Friday series on the steps to achieving financial independence. Thanks for watching.